Joining us now is Aaron Gibbs, president at Gibbs Wealth Management. Aaron, thank you so much for joining us.
Thank you.
All right, we're going to get right to it. For the quarter and for the year, value and growth, they're both in the negative, but growth has performed better. Is that still the better near-term play, and how do you see that playing out for the rest of this year?
Yeah, so a lot of investors, we find it nerve-wracking that we see that particularly growth stocks and these large cap growth stocks are just trading at these extreme valuations, and it's this mentality of this is the only place to invest and everybody's investing in them. But when you actually look at earnings expectations for second quarter and further down the year, you can kind of see why it seems like there's no other option. We're looking at growth rates, even though they're in the negative, they're half as negative as, let's say, a value stock or a small cap stock. And we've rarely seen such a big change. Now, of course, estimates are all over the place. We're not getting a lot of guidance for companies, so there's only so much you can put into it, but it's still a very significant change. So moving into new technology stocks, moving away from the Dows certainly makes sense. But I'm still recommending to our investors, let's just not look about the next 6 months, right? Second quarter has already happened. And so let's look into 2021, because I really just don't want to pile again and again and again into these super expensive stocks and let's look ahead about what might be the leaders going into 2021. And that could be very different.
Aaron, the second quarter is done, but second quarter earnings are set to start next week. What do you expect on that front, and how much of that expectation do you think is already priced into the markets at this point?
You know, I felt like even on first quarter, as well as in this quarter, that earnings season really takes a back seat to overall COVID sentiment. So like for today, as we see new cases rising out of China, that'll dominate the headlines and investor sentiment, rather than what companies are doing. And we've seen companies have huge misses or huge beats. And because we know that these estimates are just, some are much bigger guesses, let's say, than normal, where we're getting companies that aren't even giving guidance. So I think earnings season overall is really taking a back seat to looking at economic numbers, looking at unemployment, how cities and municipalities are reopening, and then statements like last night where Biden's talking about tax rates, this morning, new case counts from China. That's what is more in the forefront of an investor mind today.
Well, Aaron, I think everybody's looking for COVID-19 proof stocks and recession proof stocks. What factors create those? And if companies are really dependent on the consumer, are they actually recession-proof or COVID-19 proof?
So, yeah, I focus on companies where no matter how we're working, whether we're working from home or we're working for less, we're traveling less, but are high-quality, high-margin stocks. So one of the big things is you can't have a lot of debt. If you have a lot of debt, you're much more likely to obviously have to file for bankruptcy. So I'm looking at really strong balance sheets, strong, stable revenues, and high credit quality. And often what that means is information technology and then some very specific materials and consumer-focused stocks. So on the consumer side, I love anything that has to do with home improvement, lumber. Sherwin-Williams, it's a materials stock, but you can't buy their paint fast enough. Everybody needs to paint, create their new patios, paint their rooms that they're stuck in. Home Depot has been another one that's just been off the charts and been wonderful. So there is room in consumer. But I also love cloud technology. That is definitely the way of the world. And I'm even willing to go down into, let's say, the mid caps, not just stick with those big, large cap names like F5 Networks or Microsoft, but also Manhattan Associates, J2Com, move a little farther down the scale for true growth in the smaller companies. But again, looking at very stable balance sheets. You don't want to see too much debt. You don't want any risk of them not being able to, pay their employees and keep paying the interest. You want a nice, stable, solid company.